At Currency Secret, our mission has always been simple. Take complicated movements in gold, silver, and the dollar system and explain them in a way anyone can follow, whether you're a seasoned investor or someone just trying to understand why everything suddenly feels more expensive and less stable. And right now, there's a dangerous idea floating around markets. The idea that if silver ever hits $100 an ounce, that would be the grand finale. The end of the story, the moment everyone cashes out and the crisis is over. But here's the uncomfortable truth. If silver reaches $100, that won't be the climax. It will be the receipt, because silver exploding higher isn't the cause of a crisis. It's the evidence that the crisis has already happened beneath the surface. It's the moment when the financial system stops pretending the math still works, and when math takes control, narratives don't matter anymore. Here's why. The modern dollar system isn't just currency printed by the government. It's a gigantic global machine built on rolling debt, recycled collateral, and financial promises stacked on top of other financial promises. Countries borrow, corporations refinance, banks leverage, governments issue bonds, markets assume refinancing will always be possible. And for decades, that assumption mostly worked. But when the system reaches a point where debt can't expand safely anymore, and shrinking it would break the economy, stability disappears. Instead of stabilizing, the system shifts into a new regime. And in that regime, paper promises start breaking faster than people can update their economic models. What we're watching right now isn't random volatility. It's the early phase of a very predictable multi-stage process, one that history has shown again and again, a process that ends with money itself being repriced. What a dollar buys changes. What bonds are worth changes. What liquidity actually means changes, and what markets accept as final settlement changes. Look at the numbers. Global debt, public plus private, now sits somewhere in the low to mid $300 trillion range. Governments, corporations, households, financial institutions, everyone owes someone. And that matters for one simple reason. When debt becomes that large, the system stops being driven by production and innovation. It becomes driven by refinancing risk. Every year, massive amounts of debt must be rolled over. Old debt must be replaced with new debt. And that only works as long as markets are willing to keep lending at manageable interest rates. At that point, the economy becomes secondary. Refinancing becomes the real engine, and the endgame stops being political. It becomes mathematical, because math eventually forces outcomes that policymakers can't vote away. And this pattern isn't new. It doesn't matter what country, what ideology, or what era you look at. Monetary systems follow the same script. First comes the foundation phase. A new monetary order appears stable. A reserve currency earns global trust. Payment systems work smoothly. Capital flows freely. People believe the system is strong and durable. Then comes expansion. Credit grows faster than real productivity. Debt multiplies faster than goods and services. Governments realize inflation is easier than default. Banks realize leverage is profitable until it isn't. Financial claims expand beyond what the real economy can support. Then comes the loss of control phase. Not because policymakers are stupid, but because not all promises can be honored at the same time. Funding markets freeze, volatility spikes, and the assets everyone thought were safest suddenly become the source of stress. Finally, the outcome arrives. It always does. The unit of account gets repriced through inflation, devaluation, restructuring, or some messy combination of all three. Timing varies, the path varies, but the ending is consistent. And this is exactly why silver matters, and why obsessing over a $100 headline misses the real story. Silver isn't just a metal, it sits at the crossroads of monetary demand and physical limitation. On paper, silver can be suppressed for a long time. Futures contracts can be rolled. Exposure can be created digitally. Positions can be netted out without a single ounce changing hands. Paper supply is infinite, but physical supply isn't. Physical metal means delivery, settlement, final ownership. And when the system enters that loss of control phase, markets stop caring about theoretical pricing and start caring about something much simpler. Does the asset actually exist? Where is it? And what does it cost to take delivery? That's when premiums appear. Inventories shrink. Delivery becomes difficult. And the gap between paper price and physical reality becomes the story. To understand why this matters, you don't need complicated theory. You just need history. Because history isn't trivia. It's a laboratory. And we've already seen this mechanism play out before. Take the post-World War II monetary system created in 1944. Bretton Woods. On paper, it looked perfect. The US dollar was tied to gold at $35 an ounce for foreign governments. Other currencies were pegged to the dollar. America held enormous gold reserves and dominated global production. For a while, stability was real. Countries trusted dollars almost as much as gold. But expansion crept in quietly. The U.S. began running persistent deficits. Military spending grew. Social programs expanded. Credit demand increased. Dollars flowed overseas faster than gold flowed back in. And something critical happened. The system didn't just create more dollars. It created more claims on dollars. Offshore banking markets exploded, generating dollar liabilities beyond domestic control. Once claims exceed reserves, you no longer have a gold-backed system. You have a confidence-backed system pretending to be gold-backed. By the 1960s, foreign governments started noticing. France, under Charles de Gaulle, began converting dollars into gold. Others followed. Confidence began turning into physical withdrawals. Gold started leaving U.S. vaults. The London Gold Pool, a multinational effort to defend the $35 price, collapsed in 1968. That divergence between official price and market reality was the signal. Paper promises and physical metal were separating, and once that happens, confidence drains quickly. By 1971, the U.S. faced a brutal choice: raise rates sharply and risk recession to defend the gold peg, or break the promise. In August 1971, President Nixon closed the gold window, not because he wanted to, because the math left no alternative. The anchor had to be cut. And what followed proved the final phase. The dollar didn't collapse overnight, but its purchasing power began to reprice. The 1970s delivered stagflation, weak growth with high inflation. Bond yields surged. Volatility exploded. Gold rose from $35 to hundreds of dollars. Silver experienced extreme swings as investors rushed toward tangible assets when monetary confidence weakened. The story wasn't speculation. It was monetary repricing, and this pattern didn't stop there. Because in the next part, we'll look at another case. Very different on the surface, but driven by the exact same mechanics. When Britain lost its reserve currency dominance and learned the same painful lesson. And once you see how often this pattern repeats, you start realizing the present might not be as unique as people think. And the next example proves something important. Monetary systems don't fail because people suddenly panic one morning. They fail slowly, then suddenly, when maintaining confidence becomes too expensive. After World War II, Britain still carried the image of a financial superpower. For over a century, the British pound had functioned as the world's primary reserve currency. Trade contracts were settled in sterling. London was the center of global finance. British institutions carried enormous credibility. This was the foundation phase. Sterling worked because Britain controlled massive trade networks and financial flows across the globe. Nations trusted the pound because it had institutional strength behind it. Britain could finance itself cheaply because everyone used its currency for settlement. But wars change balance sheets. 2 world wars drained British gold reserves, destroyed industrial capacity, and left the country buried in debt. Meanwhile, new economic powers, especially the United States, emerged stronger. Yet Britain tried to maintain the illusion that sterling could still play the same global role. This was the expansion and overextension phase. Debt levels rose, welfare commitments expanded, trade balances weakened. The country's productive dominance faded, but policymakers kept trying to defend the currency as if nothing had changed. And that's always the warning sign. When a currency survives more on narrative than on balance sheet strength, the system has entered dangerous territory. The crisis phase appeared repeatedly. In 1949, Britain officially devalued the pound because defending the old exchange rate had become impossible. Then again in 1967, another devaluation followed after reserves were drained trying to maintain confidence. Each time, leaders described it as a controlled adjustment, but markets understood the truth. The system was losing control. And once investors sense weakness, every future promise becomes harder and more expensive to defend. Think about the choices policymakers face when their currency comes under pressure. They can raise interest rates sharply, but that crushes domestic growth and employment. They can burn foreign exchange reserves, but reserves are finite. Or they can impose capital controls, which damages trust even further. There is never a painless option. By the mid-1970s, Britain faced reality. Inflation surged, economic growth stagnated, and the pound remained under pressure. In 1976, the United Kingdom had to seek assistance from the IMF. A humiliating moment for a former financial empire. And the outcome wasn't one dramatic collapse, but a regime change. The pound permanently lost its reserve dominance. Inflation tolerance increased. Borrowing costs rose. Britain had to accept a weaker currency and reduced financial power. Again, same mechanism. Foundation, expansion, loss of control, repricing, different country, same mathematics. And these examples matter today for one critical reason. Monetary systems don't collapse because people stop believing. They collapse because maintaining belief becomes too costly. When promises exceed what balance sheets can support, policymakers eventually choose inflation, devaluation, or restructuring over economic collapse. And this is where bond markets enter the story. Because once debt becomes enormous, bond yields are no longer just financial statistics. They become the government's breathing rate. Debt auctions stop being routine events and start becoming survival tests. Bid-to-cover ratios, investor participation, dealer balance sheets. These technical details suddenly determine whether governments can keep funding themselves cheaply. Funding markets become the real confidence indicator. When liquidity is abundant, spreads compress, volatility remains low, leverage expands, and paper assets feel safe. But when liquidity tightens, markets begin searching for what is real, deliverable, and final. And this is where precious metals re-enter the picture, not as speculation, but as settlement assets. Paper silver can satisfy exposure on a spreadsheet, but it cannot satisfy a system that suddenly asks, what actually exists when trust disappears, when inventories start falling, when delivery notices rise, when premiums detach from futures prices, when refiners and mints struggle to supply physical demand? Then you're not watching a commodity rally. You're watching monetary trust move from paper to metal, and this is why the obsession with $100 silver misses the bigger point. Round numbers make headlines. But systems don't care about round numbers. They care about conditions. Currency stress that forces policy reactions. Inflation that refuses to fall without economic damage. Deflationary shocks that hit risk assets when funding dries up. Bond yields that rise even when central banks try to control them. Volatility that spreads instead of remaining contained. That's the environment where silver doesn't simply rally. It violently reprices, because unlike paper assets, it cannot be created by accounting entries. And here's the uncomfortable truth. In the loss of control phase, markets stop pricing assets and start pricing money itself. They price the reliability of collateral. They price whether debt can be rolled over. They price whether governments will choose austerity or stealth currency debasement. And the gap between paper claims and physical assets becomes the gap between theory and survival. We've now seen this mechanism twice. The dollar breaking its gold promise, sterling slowly losing reserve status. Different stories, same underlying math, which brings us to the real question. Has today's dollar-centered system, with its offshore dollar markets, leveraged collateral chains, endless debt rollovers, dependence on auctions, and suppressed volatility, somehow escaped this pattern? Or is it simply further along the same track than most people realize? Because the next step isn't random, it's a sequence. And once you see the sequence, you start recognizing the warning signs everywhere. In fact, we saw versions of this again in Asia during the late 1990s. Countries like Thailand, Indonesia, and South Korea borrowed heavily in dollars because dollar funding was cheap and stable. Growth looked strong, currencies were managed, and refinancing seemed easy, until capital flows reversed. In 1997, Thailand was forced to abandon its currency peg. Exchange rates collapsed. Suddenly, dollar debts became unpayable in local currency terms. Strong businesses went bankrupt simply because their liabilities exploded overnight. Contagion spread across Asia because banks, trade financing, and investors were all interconnected. Then, in 1998, Russia defaulted and global markets nearly froze. Highly leveraged hedge funds like long-term capital management collapsed when funding conditions changed. The issue wasn't just bad bets, it was funding dependency. When funding disappears, even good assets get liquidated. And again, the outcome matched the pattern. Violent repricing of risk and liquidity, with the dollar at the center because global debt was denominated in dollars. And now, we're watching similar mechanics begin again, only this time at a global scale, which is exactly where the story continues next. End of part 2 flows directly into modern dollar system discussion, and this brings us directly to the present moment. Because when people talk about the dollar system today, they often imagine stacks of green paper or central banks printing money. But the modern dollar system is far more complex than that. It's not paper currency. It's a global web of dollar liabilities, collateral chains, derivatives, offshore banking systems, and funding markets that operate every single day beneath the headlines. International trade settles in dollars. Commodities are priced in dollars. Banks fund themselves in dollars. Corporations borrow in dollars. Governments issue dollar-denominated debt. And through FX swaps and derivatives, even institutions without direct dollar borrowing still end up exposed to dollar funding conditions. In other words, the world is structurally short dollars. Not because dollars are scarce, but because global growth has been financed through borrowing them. And this works perfectly until funding becomes tight. For years, low interest rates and suppressed volatility encouraged leverage everywhere. Debt expanded. Governments rolled over larger obligations. Private credit exploded. Financial firms built trades dependent on stable funding conditions. Many strategies looked safe only because funding was cheap and liquidity was abundant. Take something as simple as a basis trade. A fund buys treasury bonds and shorts futures, earning small spreads with leverage. On paper, it looks like arbitrage. But in reality, it depends entirely on stable repo funding and collateral values. As long as markets remain calm, the trade works. But when liquidity tightens, these trades become fragile. And this is where crisis mechanics begin. Foreign exchange markets usually show the first signs of stress. When the dollar strengthens sharply, financial conditions tighten globally. Countries and corporations earning local currencies suddenly face higher costs servicing dollar debts. A strong dollar sounds patriotic, but financially it acts like a wrecking ball for emerging markets and heavily indebted economies. Central banks burn reserves trying to defend currencies. Interest rates rise into slowing economies. Capital flees toward safety and yield simultaneously. Local stress becomes global stress. And then comes the strange part. Inflation and deflation can happen at the same time. A stronger dollar can crush commodity demand and asset prices in some regions, creating deflationary pressure. But elsewhere, weaker currencies make imports expensive, pushing inflation higher. Policymakers get trapped. Raise rates to defend the currency, and you trigger recession. Cut rates to support growth, and the currency weakens further, importing inflation. There's no painless solution, and then the real arithmetic problem appears: debt rollovers. Governments constantly refinance maturing debt while issuing new debt to fund deficits. Markets must absorb this supply at current yields. Watch debt auctions carefully. If bid-to-cover ratios weaken, if auctions tail higher, if primary dealers are forced to hold excess inventory, it signals demand resistance. And when demand weakens, prices fall and yields rise. Higher yields increase interest expenses, expanding deficits, forcing even more borrowing. That feedback loop is the debt trap in real time. And yields matter more than headlines suggest. Nominal yields can rise because inflation expectations increase, because real rates increase, or because investors demand extra compensation for uncertainty. The term premium. When term premium rises, it changes everything. It means markets are demanding compensation for fiscal instability and policy risk, beyond what central banks can control through short-term rates. And this connects directly to gold and silver. In textbooks, rising real yields hurt gold because the opportunity cost increases. But in real crises, rising real yields can coincide with gold rising, because yields are rising due to declining confidence, not healthy growth. That difference separates classroom economics from crisis reality. And the stress usually becomes visible in funding markets before the public notices. Repo markets are the heartbeat of modern finance. Banks and funds borrow against collateral daily. When collateral is trusted, repo rates stay orderly, leverage rolls smoothly, and liquidity feels abundant. But when stress hits, haircuts increase, margins rise, funding costs spike. Swap spreads behave strangely. Cross-currency basis widens. Markets begin paying premiums for dollar funding. The message is simple. Dollars are becoming scarce at the margin, and now leverage turns dangerous. Funds running leveraged treasury trades or relative value strategies suddenly face rising margins and funding costs. They don't sell because their analysis changed. They sell because funding disappeared. Forced selling pushes bond prices down and yields up. Higher volatility forces more selling. And because treasuries are the system's primary collateral, stress spreads everywhere. The safest asset becomes the transmission mechanism. Then risk assets react the way they always do during genuine dollar squeezes. Stocks fall. Credit spreads widen. High-yield debt reprices. Liquidity disappears when everyone needs it most. Volatility stops being a tradable strategy and becomes a system-wide event. And this is the moment when markets rediscover the difference between price and liquidity. If you must sell, the price is whatever bid exists. And sometimes the bid barely exists at all. Now, and only now, precious metals return to center stage. Gold and silver stop behaving like ordinary commodities and start functioning as monetary stress valves. Gold remains the primary monetary metal, deep liquidity, central bank demand, and historical trust. Silver, however, behaves differently. Because silver sits between industrial commodity and monetary asset. In tightening cycles, silver often falls first because it reacts to growth expectations. But when disorder arrives, silver can snap violently higher as buyers shift from speculation to necessity. And this is where the $100 silver myth collapses, because the real question stops being price. The real question becomes availability. Can you source physical metal? At what premium? How long does delivery take? Paper markets allow enormous exposure compared to physical inventories. Contracts get rolled and netted daily. That works fine until participants start demanding delivery instead of exposure. And when investors want allocation instead of promises, the structure strains. Delivery notices increase. Inventories shrink. Premiums widen. Retail and wholesale prices detach from futures markets because fabrication capacity and logistics are limited. Markets begin paying for immediacy and certainty. And that is when feedback loops begin. Mine supply cannot ramp up overnight. Recycling responds slowly. Industrial demand remains sticky in many applications. So when investment demand rises in a tight market, metal must be bid away from someone else. And that's how violent repricing happens. Not because everyone suddenly loves silver, but because the system is searching for deliverable value when deliverable trust is scarce. And gold follows the same logic at a larger scale. Central banks accumulate gold not because it's fashionable, but because it carries no counterparty risk. In a world of sanctions, reserve weaponization, and geopolitical fragmentation, gold becomes neutral settlement. Private investors follow when they realize bonds can lose purchasing power even while paying interest. And in late stages of monetary stress, gold stops being a trade. It becomes a report card on policy credibility. And when we stitch all these mechanics together, the sequence becomes clear. Dollar strength triggers global stress. Inflation and deflation pressures collide. Debt rollovers push yields higher. Funding markets transmit stress through leverage. Risk assets fall as correlations converge. And finally, markets search for settlement outside the paper promise system, which leads directly into the final stage of the sequence. And that is exactly where our story moves next. And this is the point where most people make their biggest mistake. They keep watching headlines instead of watching mechanics. Because by the time headlines admit there is a crisis, markets have already repriced. Damage is already done. Liquidity is already gone. The people who survive these transitions are not the ones predicting exact dates. They're the ones watching the plumbing of the system. So what should you actually watch? Start with dollar funding conditions. Not just the dollar index, but cross-currency basis swaps and FX funding costs. When banks and institutions start paying a premium to access dollars, it's a signal that liquidity stress is spreading. Then watch treasury auctions. If bid-to-cover ratios weaken, if auctions tail, if dealers end up holding too much inventory, it means demand for government debt is faltering. And if demand weakens, yields must rise. Rising yields tighten financial conditions everywhere. Then watch term premium and yield curve behavior. When investors demand extra compensation to hold long-term bonds, it signals growing uncertainty about inflation, fiscal stability, and policy direction. Watch real yields and inflation expectations, not because they perfectly predict metals, but because they reveal what markets fear: weak growth, inflation, or loss of credibility. Then watch funding markets themselves: repo rates, swap spreads, collateral availability. If collateral chains tighten and funding costs rise, leverage starts unwinding, forced selling begins, liquidity evaporates, and when liquidity disappears, correlations rise, stocks fall together, credit markets weaken together, volatility spreads across asset classes, everything becomes connected in the wrong direction. And finally, watch metals, but watch them correctly. Don't just look at spot prices. Watch physical premiums. Watch delivery delays. Watch inventory reports. Watch the gap between futures prices and what dealers actually charge for real metal. Because when paper markets look calm but physical supply tightens, that's when the stress valve is opening quietly. And here is the warning that needs to be said clearly. This time is not magically different. American exceptionalism is not a law of physics. Technology innovation does not cancel debt math. Optimism is not collateral. Financial systems can innovate and still break because innovation doesn't erase arithmetic. Debt still needs refinancing. Auctions still need buyers. Liquidity still cycles between abundance and scarcity. Your job isn't to guess the exact day something breaks. Your job is to understand the sequence so you don't become the liquidity exit for someone else, selling assets at the worst possible moment because you waited for certainty that only appears after damage is done. Think like a risk manager, not a hero. Watch plumbing, not pundits. When dollar funding stress rises, assume volatility will follow. When auctions weaken and yields rise, assume refinancing pressure is building. When repo and swap markets signal balance sheet strain, assume leverage is being forced out. When physical metal premiums widen while paper markets stay calm, assume trust is quietly shifting away from financial promises. Because markets don't usually explode from drama, they reprice from mechanics. And those mechanics are already moving. When the dollar machine tightens, it forces liquidation. When it loses control, it forces revaluation. And when the stack of paper promises become suspect, metals become the receipt. So the final question isn't whether silver hits $100. The real question is this: are you watching headlines, or are you watching the plumbing? Because the next stage never arrives with a warning siren. It arrives through small signals most people ignore, until suddenly everyone sees them at once. And by then, prices have already moved. The sequence always looks obvious in hindsight. The winners are the ones who understood it in advance. And now you know what to watch.